Building wealth through passive income is one of the most powerful strategies available today. And while there are numerous ways to generate passive income, focusing on exchange-traded funds, ETFs, and dividend-paying stocks is a solid approach. To harness the full potential of these investments, it's essential to follow specific guidelines and make smart choices that will support long-term growth and financial freedom. Exchange-traded funds, ETFs. When you think of ETFs, think of liquidity. A liquid market means you can easily buy and sell shares without facing high transaction costs. Ideally, choose ETFs that trade millions of shares daily. This guarantees that the ETF has a large and active market, which reduces the risk of market manipulation and helps you get in and out of trades quickly, without slippage. Additionally, opt for ETFs managed by well-established financial institutions. Big asset managers, like Vanguard, iShares, and State Street, have years of experience and billions of dollars in assets under management. They provide stability and have the resources to navigate through various market conditions, making them solid choices for long-term investment. Dividend stocks. Dividend-paying stocks provide a reliable income stream, but it's essential to focus on companies that have a proven track record of paying and growing dividends. A strong dividend history indicates a company's ability to generate steady cash flow, which is critical for maintaining long-term stability. A good rule of thumb is to look for stocks with dividends that have been growing steadily over the past few years. The payout ratio, or the percentage of profits paid out to shareholders, should also be within a reasonable range. If a company is paying out too much, say more than 70% of its earnings, it might signal that the dividend is unsustainable in the long run. Instead, aim for companies with a healthy balance between reinvesting in growth and rewarding shareholders. Real estate. Investment trusts, REITs. Real estate can also be an excellent source of passive income, particularly through REITs. But just like with dividend stocks, not all REITs are created equal. Choose REITs that have been in operation for a few years, as these tend to be more stable and have a history of reliable performance. Also, focus on REITs that invest in physical properties, those that own real estate, rather than relying on mortgages or loans. Physical properties generally offer more long-term stability and less volatility. To get the best return, also look for REITs with consistent funds from operations, FFO, which reflect the profitability of the company. A solid FFO shows that the REIT is generating enough income to continue paying out dividends to shareholders. Master Limited Partnerships, MLPs. MLPs are unique investment vehicles, often in the energy sector, that offer high yields. However, they also come with certain complexities. To avoid risk, ensure the MLP has been in business for at least 3 years and has a history of stable payouts. One of the most important metrics for evaluating MLPs is the distribution coverage ratio. This number tells you how well the MLP can cover its payouts with its earnings. A ratio above 1.2 indicates that the MLP is generating enough cash flow to sustain and potentially grow its payouts. MLPs with higher coverage ratios are less likely to cut distributions, making them safer choices for passive income. Closed-end funds, CEFs. Closed-end funds, CEFs, are another option for generating passive income. These funds have a fixed number of shares and trade like stocks. The key to choosing a good CEF is liquidity. Ensure the fund has a daily trading volume of at least 100,000 shares. This ensures you can easily enter or exit your investment without paying a premium. In addition, focus on CEFs that are trading at or below their net asset value, NAV. If a CEF is trading at a large premium to NAV, it might be overpriced. Instead, look for funds that are trading near or below NAV, which offers more potential for value growth. Example. Portfolio. How it works in action. Let's consider a $1 million investment aiming to generate a consistent income. Instead of picking specific stocks, we'll break it down by asset class and see how diversification works. Group A. ETFs and stocks with monthly dividends. Invest in a diversified mix of index funds and ETFs that pay monthly dividends. These could include broad market funds like the S&P 500 ETF, sector-focused funds like those focused on healthcare, and funds tracking international markets. Allocate a portion to dividend stocks from stable blue-chip companies, particularly those in industries like utilities and consumer staples. Stocks like Procter & Gamble, Johnson & Johnson, and Coca-Cola tend to have solid dividend-paying records. Group B. Real estate and alternative assets. Allocate a portion to real estate investments, focusing on REITs with exposure to commercial properties such as office buildings or retail spaces. Alternatively, consider REITs in the healthcare sector, such as those focused on medical facilities, which tend to provide stable cash flow. You can also diversify with MLPs in the energy sector or even bonds, especially if you're aiming for lower risk investments that will generate steady income. Group C. High-yield assets and growth potential. Allocate some funds to high-yield savings accounts, bonds, or other low-risk investments, ensuring they provide a steady return. Consider adding some higher growth stocks with consistent earnings, even if they pay lower dividends. These stocks offer long-term growth, while your dividend-paying stocks and REITs provide regular income. Income breakdown. Let's say this diversified portfolio of ETFs, dividend stocks, REITs, and MLPs generates an average yield of 4.5% annually. With a $1 million portfolio, that translates to $45,000 a year in passive income, around $3,750 per month. You could reinvest the dividends for compound growth or use them for living expenses, depending on your financial goals. This strategy is scalable, whether you have $500,000 or $5 million to invest. The core principles remain the same. By carefully selecting the right assets and diversifying across different income-producing investments, you can create a sustainable, passive income stream that grows over time. Final thoughts. The idea of earning money without constantly working, for it sounds like a dream, but it's entirely achievable with the right strategy. By focusing on high-quality, stable assets like ETFs, dividend stocks, REITs, and MLPs, you can create a portfolio that generates consistent income while maintaining the value of your principal. Over time, this approach will provide the financial freedom to live life on your terms. The key is to start today. The sooner you begin building a passive income portfolio, the sooner you can take advantage of compounding and start reaping the benefits. With patience and smart decisions, a financially independent life isn't just a possibility. It's within your reach.